Hello everyone, welcome to part 2. In this video, we are going to be talking about the alternative minimum tax, or AMT. So what the alternative minimum tax is it is a tax based on an alternative or more inclusive tax base than simply just regular taxable income. And it is designed this way to ensure that taxpayers are paying some sort of minimum level of tax. And so the alternative minimum tax is more targeted for higher income taxpayers, so such as taxpayers with larger amounts of capital gains. And the reason why is because higher income taxpayers may be benefiting from tax preferred items like exclusions, deferrals, and certain deductions that reduce or eliminate their tax liabilities. And those higher income individuals may be using those items more than Congress had intended them to. And so then this alternative minimum tax essentially presents a different kind of tax base that allows those individuals to hopefully pay some sort of tax. So we're trying to make the system as equal as we can. And so on the next slide, we're going to go through the alternative minimum tax formula. And in there, essentially what we're doing is we are going from regular taxable income to the alternative minimum taxable income. And so to get there, there are various adjustments. And some common adjustments could be tax exempt interest from municipal bonds, for example, state and local income taxes, and any real property taxes. So to calculate alternative minimum tax, we start with our regular taxable income. Then we add the standard deduction if the taxpayer deducted the standard deduction whenever they computed their regular taxable income. Then we add or subtract other adjustments, such as the tax exempt interest that we had talked about, real and personal property taxes, state income or sales taxes, any exercise of incentive stock options, depreciation, state income tax refunds, gains or losses on sales of assets. And then that gets us to our alternative minimum taxable income. Then we would subtract any alternative minimum tax exemptions, if there is one, and we'll talk a little bit more about what those exemptions are on the next slide. Then once we subtract out any exemptions, we get our tax base for alternative minimum tax. Then we multiply that base by the alternative minimum tax rates. And so what those rates are, it's 26% of the first $239,100. And then it is 28% on the alternative minimum tax base in excess of that $239,100. And that will get us to our tentative minimum tax. Additionally, it's also important to note here that net long-term capital gains and qualified dividends are taxed at the same preferential rates, just like we would use for regular tax purposes. Then we take our tentative minimum tax and then we subtract out our regular tax. And then if there is an excess amount, so if our tentative minimum tax is greater than our regular tax, then that would result in a taxpayer having an alternative minimum tax amount. So like we mentioned on the previous slide, there are exemptions for the alternative minimum tax, and these exemptions exist to help make sure that lower income taxpayers are not required to pay the alternative minimum tax. Like we said a little bit earlier, the alternative minimum tax is really targeted toward the higher income taxpayers. So these exemptions, they are based on your filing status, and the exemptions are phased out for 25 cents for each dollar over your threshold. All right, that is everything for this video, and I will see you in part 3.